Good afternoon, everyone, and welcome to the second webinar in the series being run jointly by RUSI and Standard Chartered. Last week we heard about the proceeds of cybercrime, and today we'll be talking about new methods of payment and financial crime. So my name is Catherine Woods. I work in Standard Chartered's outreach team within financial crime compliance. My background is in all categories of risk and organisational change, and the work that I do for Standard Chartered is leading our outreach work on innovation. I am delighted to have so many people joining the webinar today, and shortly I'll be introducing my four expert and fascinating panelists. So as a way of introduction, financial services are now part of a digital lifestyle which encompasses digital payments, communication, music, streaming video, education and gaming. And this reflects broader social trends, which in some cases have been accelerated by the global pandemic. So for example, lockdown in many countries in response to coronavirus has resulted in an increase in demand for online entertainment. So speed and convenience are key, and new technologies and methods of payment have developed to meet those requirements. But with any new technologies, new payment methods also create opportunities for criminal networks, as well as opportunities to detect and disrupt illicit financial flows and to help customers better protect themselves. So that's going to be the focus of our panel discussion today. So to introduce our speakers, first up, we have Vincent Lee, who is the Chief Compliance Officer of Ant Bank in Hong Kong, one of 8 virtual banks whose licenses were granted last year. Vincent's prior experience includes financial services, law enforcement and the public sector, including 13 years in the Hong Kong Police, 4 years as the Chief Privacy Compliance Officer in the Privacy Commissioner's Office in Hong Kong. And he's also been the chairman of the AML committee at the Hong Kong Association of Banks and a member of the expert group for FATF guidance on digital identity for customer due diligence. Welcome, Vincent.
Hi.
Secondly, I'm very pleased to welcome Malcolm Wright. He's the Chief Compliance Officer for Diginex, which is a blockchain-based financial services firm based in Hong Kong. Prior to that, he was the Chief Compliance Officer at Revolut in London, and he's the Advisory Council Chair of the AML Working Group, co-lead at Global Digital Finance, which is an industry-led initiative setting codes of conduct and best practice for the crypto asset industry. So some of Malcolm's work there was to lead the development of an industry messaging format for virtual asset firms called IVMS 101, which we will find out more about later. Welcome, Malcolm.
Thank you, Catherine. Hi, everybody.
Chris Q. Smith works in compliance at Standard Chartered, and his focus is on crypto assets. He's previously worked for regulators both in Abu Dhabi and in London. Welcome, Chris. And Kaysa Eisenman is a research analyst at RUSI's Centre for Financial Crime Studies. So her primary areas of research include cryptocurrency risk and compliance, and the intersection between emerging technology and national security, including sanctions. Prior to joining RUSI, Kayla worked at the US Department of State and the US Department of Commerce. Welcome, Kayla.
Hi, thanks for having me.
So we've spoken about the trend towards blending entertainment, finance and communication. So today what we're going to do is we'll focus on 3 specific trends within those themes. The first one is the rise of virtual banking and online payment services. So in these situations, there may not be any face-to-face interaction with a new customer when they join or through the relationship with them. And that's particularly important in the current environment where face-to-face contact might not even be possible. So the question we'll ask is, does this present higher financial crime risks or new and more effective ways to identify and manage risks? We will hear more about how perceptions are shifting both within the industry and from standard setters and regulators. The second theme we'll look at is a new method of payment and asset class, crypto assets. So accessibility is increasing as new platforms simplify trading in cryptocurrencies. The market is growing more mature with the emergence of derivatives on assets like Bitcoins, and commercial enterprises are launching stable coins, which is perhaps prompting central governments to consider issuing digital currencies of their own. So the challenges presented by crypto assets to AML or anti-money laundering are widely discussed, and they include anonymity or pseudo-anonymity. But in some cases, blockchain can also present opportunities, one of which is traceability. So whereas traditional transactions were limited in how they could be shared, outside the financial institution where they occur, blockchain transactions are more readily accessible and they're more traceable than cash. So we'll look at some of the methods that are available to analyze transactions and link them to identities for real world identities, development of global standards, and we'll consider how we can encourage innovation while managing risk. The third theme that we have is we'll look at online gaming as distinct from online gambling, although there are overlaps, and how a change in business models creates a new opportunity for financial crime. So whereas once online gaming revenues were primarily sourced from selling games, those revenues are now increasingly derived from in-game purchases. They're worth millions of dollars and they present new opportunities to launder criminal proceeds. There have already been some examples of significant funds being laundered this way. So just before we get into the questions, just a reminder, please keep adding your questions and answers into the question answer box. We'll answer them throughout or in the later part of the session. So Kayla, if I can start with you, can you tell us more about your research on how online gaming can be used to launder money and the methods by which that actually occurs?
Yeah, definitely. Hello, everyone. So yes, recently my colleague Anton and I published a paper on money laundering through online gaming, a subject which we found at least was understudied. So we had a really good time actually looking into it, speaking with game developers, etc. And obviously, as I'm sure you're all aware, video gaming and online gaming in general has increased massively throughout sort of the COVID crisis. So I think this is relevant now more than ever. And we all, of course, know that cyber criminals are taking advantage of the pandemic. So the typologies that we were seeing when we did the research at, I think, the end of last year, I would assume have grown. Obviously, stats for that haven't particularly come out yet, but I'm just going to quickly share some of the specific typologies we were seeing and maybe give you a sense of how criminals are using these sort of funding streams to launder funds. So there are three major ones that I think we really discovered, and I'm going to spend the most time talking about the third. So the first is what the term is lifestyle spending. So if you gain funds from any type of criminal activity and then you don't quite launder them out into fiat cash on the other side, but you put them into the game because you want, the best clothes in game, you want to be at the highest level, you put it into World of Warcraft or you put it into whatever it is, because most games, if not all, but at least most, you can easily transfer fiat currency into in-game currency. The difficulty, as I'll talk a little bit about on the other end, is transferring in-game currency to fiat. But if you want to stop at having it in-game because you're interested in, your lifestyle in-game increasing, then you're just funneling illegal funds into the game. And that's the first one that we saw. The second one is sort of automating stolen credit card details and moving them through games. We've seen, there have been reports published on this happening with Fortnite and also with the Apple App Store and games in the Apple App Store where criminals were getting bank card details from the dark web, just from sort of sketchy sites, and automating buying transactions in, say, Clash of Clans or Fortnite and buying up in-game items, and then either using it for lifestyle or then sort of trying to sell their accounts. So the third one that we saw, and probably what we would class as the biggest risk here, is third-party marketplaces where you're able to resell either items or accounts or the in-game currency itself in order to gain fiat currency again. So it's sort of the back end of, it's easy to get it into the game, but the question is, once it's in the game, how do you move it back out if you're trying to really move the funds? And similar to, cryptocurrency, as I'm sure we'll talk about later, the difficulty is always the exit point. So the difficulty here is that most in-game marketplaces, the legal ones at least, so like the Steam marketplace or the Apple App Store, don't make it easy for you to move funds from inside the game back out, because they want, first of all, on a company level, they want to keep your money, but also they are sort of worried about money laundering and they don't want funds just going straight through the game. So what's popped up are an abundance of third-party marketplaces. And if you look up any type of third-party marketplace for video games and online gaming, all you have to do is Google, buy World of Warcraft, buy Clash of Clans. I'm just using these examples. You can really do it with any online game that has an in-game currency, because there are people who value the in-game currency. And a lot of our research was really trying to show people that in-game currencies hold a huge amount of value for a lot of people. I'm not an avid online gamer, but there is an audience for every single game, and there are examples of it. There are people who will pay thousands and thousands of real US dollars for one single sort of fancy in-game item. And this ranges from everything like sort of the massive multiplayer online games that I was talking about, but also people will pay for it in Animal Crossing. That's some research that we did recently. They'll certainly pay for it in Fortnite, where celebrities and singers are putting on concerts in game right now. So it's not limited by the type of game. It's just the sense that if people will pay for it, as with anything else, then there's a marketplace, and that marketplace isn't being facilitated by the legal entities, so it's being facilitated by these third-party marketplaces, where they'll say, I will pay you X amount of dollars for, you know, your account at level 40, or for this one item, etc. And those marketplaces are truly everywhere. We have sort of some examples of them in the paper that we wrote, which is called Gaming the System, if anyone's interested. But I obviously am not going to run through them right now. But there's a huge amount of them. They're actually really interesting to look at. And so, yeah, I think the difficulty that occurs, and this is sort of similar with cryptocurrency, it's sort of similar with online gambling, is that it's difficult to move money through this at scale. So I think that's probably the reason it's understudied, because if you think about it, you're not going to be moving millions of dollars into a game and then back out on a third-party marketplace, because you need a buyer. So the buyer doesn't have to be complicit, as a lot of people in sort of money laundering funding streams aren't. They certainly can be. And it's more likely that they will be if you're working in a situation where you're trading from one player to another player. But if you're selling, say, an account on a third-party marketplace, then that person doesn't necessarily know what's going on, and therefore it's going to be difficult to move a huge amount of money. And a lot of in-game currencies, even with the amount of value that they hold, are worth less. Like one, coin is worth less than $1. So when you're moving huge amounts of money, you're then talking millions in your in-game currency. So it's certainly difficult to do at scale. And I wouldn't say that it's, the foremost money laundering problem facing the world right now. But I think it's definitely something to watch, especially as online gaming increases, and especially as more and more people, especially right now, get involved in online gaming without really understanding how the economies that they're in game are actually working.
Excellent. Thanks, Kayla. One distinction with the gaming industry is that gaming operators aren't regulated, so they're not subject to the same oversight as financial institutions. What do you think is the role of a gaming operator or a gaming provider or a payment processor, and how do you think the responsibilities between them fit together?
Yeah, it's sort of difficult because they aren't regulated, and potentially, I guess, especially when you've just heard what I've just said, you'd think, well, they should be because they're moving money. But if you're going to accept that they're not, which we have to, then I think they do have a responsibility. And I think there are a few that have stepped up to the plate in that sense. But it's sort of like, I also look at crypto, which again, we'll talk about later. So this reminds me of the earlier days of crypto before it was regulated, but the companies themselves were concerned about money laundering on their platforms. And it's sort of like a proactive self-policing situation where if you don't want, FinCEN coming down with fines for you, and you don't want bad reputation because there's a newspaper article published in the New York Times saying people are money laundering through Fortnite, which happened, then you have to worry about it as a developer, as a payment service provider, as a gaming developer. So there is a responsibility there. It's not forced upon them, but it's there. And I think there are sort of two examples that we saw when we were doing this research, and actually one came out after, where we were seeing that they do have the capacity to do something. So the first thing that we thought about is, listen, when you're playing an online game, sure, they're not doing KYC on you the way that a bank or even a crypto exchange would, but the amount of data that they have on you as a person is huge, because you've put I assume if you're moving money through it, you've put some sort of bank details in there. You have some sort of name, even if you've not given them their real name, you'll have like an ID, you'll have a player code, something like that, a gamer tag. They'll know where in the world you are based on when you're playing. They'll know what types of transactions you do, whether it's coming, outside in, or whether you're only transacting in-game, or whether you're trying to move funds out. They'll know when your account was created. Did you just buy it from someone else? That sort of thing. And that's generally how they're able to moderate anything that goes on in a game. But I think people don't understand how much data gaming companies actually do have on them, because even if you're like, I'm not going to provide them with anything, they see when you're playing, so they know what your time zone is. It's just stuff like that. And if they have that kind of data, then what we've seen is that they actually do have a significant amount of data to be able to catch things like money laundering and fraud. So in October 2019, Valve, who are the developers of Counter-Strike Global Offensive, which is a huge online video game, they came out with a statement saying, listen, they have these things called container keys. I'm not going to get into it, but there was this typology that they were seeing where there was this one type of purchase that they were consistently seeing it, and not every time, but most of the times they saw it was fraud. And they were able to identify that it was fraud, and they put a statement out saying, listen, we're not stopping the transactions with this. We're not, completely ending your ability to trade these keys, but what we are ending is your ability to trade these keys player to player in game. And they said, this is because all the transactions we've seen about this is fraud, which to us was a great step, and also validated the fact that these gaming companies do have a sense of what's going on. I'm not saying they can stop every single type of money laundering, but they obviously have enough data to be able to analyze typologies in general and to see trends and be able to identify that sort of thing. So Valve coming out and saying that was a decently big step, I think, and indicative of what they could be doing as what all game developers could be doing, and not just Valve. Similarly, Linden Labs, who are the developers of Second Life, which is sort of an online game that's a lot like The Sims, they came out, they've been doing this for years. They registered this company called Tilia as a money services business in the US. And they just said, listen, we understand that we're operating with currency. We let people trade in and out of fiat currency. This is a part of our game. You're not regulating us, but we don't want to worry about you potentially coming down with a fine. We're just going to register our own MSB and sort of regulate ourselves. And so that's certainly another step. They're, as far as I'm aware, the only big game developer that's decided to do that. But I think those were two sort of best practice examples of where this could go, regardless of if regulation is coming down hard, because if I were playing, Counter-Strike Go, I would then feel more comfortable in using the game, because I would know nobody's taking advantage of me. My in-game transactions aren't, so it's because fraud hurts someone. So it doesn't just hurt the game. You assume that there's also potentially someone else in there who's a victim. So I think it's good to self-police. I don't think it's terrible saying that video games facilitate this and this is what they can do next. But I think there's been some good examples of what that can look like.
Thanks, Kayla. There's some really good points in there about the wider effects of financial crime, and also some really good examples of what gaming operators can actually do. So maybe we'll come back to some of those themes when we get to the Q&A. But for now, I'd like to ask you some questions, Vincent. So we've seen increasing demand for speed and convenience, as we mentioned, while also recognizing that risks need to be managed. So can you share with us some ways that technology could be used to improve customer experience, for example, by making AML less onerous or intrusive, but also allowing risks to be more effectively managed? So digital identification and verification might be one example, but welcome any experiences that you'd like to share.
Thanks, Kathleen. Can you hear me? Yeah, actually, I have to say, having worked in the traditional banks for more than 15 years, the experience here in the TechFin firm is eye-opening. Some of you may have been aware of the new guideline issued by the FATF on digital ID for CDD purposes. And indeed, it has been clearly stated in the new guidance that non-face-to-face customer onboarding could be standard risk or even lower risk if reliable and independent technology could be used. So I have been working in traditional banks for more than 15 years on AML. To me, the two most fundamental elements of the whole AML journey. R, to ascertain who are you, and then you are you. When you think about it, for ascertaining who are you, you will just get the ID proof from the customer. And in a branch, he will come forward to you, and then the teller will examine the ID proof. In virtual bank, in tech firm, what we are trying to do is to use technology to authenticate the ID proof. And actually, not just my firm, now there are quite some firms which are able to authenticate more than 90 different types of ID proof and passports. This is far more reliable. When you think about it, your colleagues in a bank may be quite familiar with the ID proof issued by the domestic authorities, but that's it. If he is given a foreign passport, it is really difficult for him to say whether it is a genuine passport or not. With the technology to authenticate the ID proof, this is far more reliable. So what the customer needs to do is to take a photo of the ID proof from different angles and then upload the photos to the tech firm or the virtual bank. When we are able to authenticate the genuineness of the ID proof, far more reliable and effective. So the first point about who are you can be more effectively satisfied by technology. As regards the second element, you are you. Okay, again, in a branch, you will look at the photo of the ID proof and then look at the one standing in front of you. In the case of Hong Kong, the last generation of ID proof was issued some 15 years ago. So people will look differently, and it may not be too polite. It may be quite intrusive for you to ask the customer standing in front of you, hey, madam, do you have another ID proof? Because, well, you just don't look like the one appearing in the passport in the ID proof. No one in the banking sector will do it. With technology, we are able to use face recognition. So you are asked to have a selfie. It's not a photo, it's a video clip, about 2 seconds. And then you need to close your eyes, you need to move your neck, etc., to prove you are a living individual. And then we will create a 3D profile according to your ID proof and based upon the selfie. And we are able to even differentiate between twins. So this is far more reliable and effective to use face recognition technology to satisfy the second element, who, i.e. you are you. So I would say now taking customers on board remotely is no longer a higher risk scenario. In most cases, it is even of a lower risk.
Thank you, Vincent. That is amazing that you can distinguish between twins. That is quite impressive. And Malcolm, I can see you nodding to a few points in there. Was there anything you wanted to add to this discussion point?
Yeah, I mean, I completely agree with what Vincent says. You know, the ability to use non-face-to-face and to use some of the digital technologies that are now emerging really can differentiate between that in-branch experience where somebody maybe had local knowledge to being able to identify, as Vincent says, 90 different IDs or so on. I think the danger that can exist because this is emerging is that there's different technologies out there, and we know that Vincent's using sort of live ID, which is a key component of being able to, for example, mitigate the risk of stolen identities and stolen sale fees and things like that. So that live ID piece is really important. And this is where I think compliance staff need to really pay attention to, if they are looking to move into this direction, or technology teams even, if they are looking to move into this direction of non-face-to-face, and particularly in this kind of post-COVID world, I think we're going to see an emergence of, or an acceleration of that. then it does become more important to ensure that that technology is validated and that it is using things such as liveness and the sort of 3D kind of effect to be able to see the different biometrics or visual identity components of an ID, such as holograms and so on and so on and so on. But I agree with Vincent completely. I think it's a way to not only to reduce that risk of financial crime and being able to commit fraud with a fake ID, but it also allows for the customer experience to improve. It creates much more frictionless engagement. And I think the firms that will succeed, like we're seeing with sort of Bank, are creating that frictionless experience is really what will become key for the next generation of banking users.
Yeah, thanks, Malcolm. Agree with you entirely. And actually, being a former cop, I would say, even though for traditional banks they have very intensive, if not intrusive, KYC processes, if a guy is a criminal, is minded to get the banking facilities and account, definitely he or she will give whatever you want in order to open the account. But they can lie to you. Their transactional behavior cannot. And that's why for tech firms like mine, we are trying to use technology to do effective and more automated transaction monitoring, because you can lie to me, your behavior cannot. And by using technology, we are not talking about just volume, amount, frequency. We are able to detect, for example, you are using the same device with different phone numbers to open accounts. And we are able to detect where you are when you are transacting. We are able to know the timing of your transaction. If you are using your mobile phone to make some payment and the merchant is not an online shop, it is a store around the corner of the street, it doesn't quite make sense for you to have all these transactions after midnight. It's not 7-Eleven, right? If, for example, if there's a boutique. So by using technology, we are able to ascertain. That's even more important. You are actually what you are claiming to be according to your customer profile.
Excellent, thank you, Vincent. So it's not just at the start of the relationship, but ongoing throughout the relationship as well.
Yeah, exactly.
So I'd like to move on then to our third theme for today, which is about crypto assets. So Malcolm, first of all, crypto assets are one of the newest forms of payment, and through your work with industry groups, can you tell us more about how the thinking of standard setters like FATF, as well as industry is developing, in particular the FATF guidance for virtual asset service providers, the travel rule and the new standard that you've been working on, and how they help fight financial crime?
Yeah, thank you, Catherine. So the FATF journey with crypto assets really, I mean, there were past papers back in 14-15, but it really began in October 2017, where the first statement started to really emerge on the future regulation of virtual assets and virtual asset service providers, so exchanges, custodians, OTC houses, and so forth. The guidance then emerged, and where the definitions of virtual asset and virtual asset service provider, or VASP, were then really embedded in February 2018. And as part of that, it became very clear that this was really about stopping unfettered access for criminals and sanctions evasion and terrorists to this sort of unregulated ability to move value transfer, so to go from fiat to crypto to another crypto exchange, or move it around and then back out to fiat again. So obviously there was a large gap there in terms of a regulatory response, and the FATF started to address this. We had a meeting in May of 2018 in Vienna, which was the industry and the FATF participants. We came together to discuss the various challenges really about being able to introduce certain aspects of the regulation. Some of it relatively straightforward, do KYC. That part is fairly well established. Harder parts, we're really looking at recommendation 16. So what is in the traditional financial sector is wire transfers. In crypto, it's going to be it's also known as the travel rule, but that was also in the existing financial sector. So I'll refer to it as the travel rule, as this is the easiest way to explain that. It's about the information about an originator who's sending a payment, traveling with the payment to the beneficiary or to the beneficiary's exchange. So this was the more contentious part as to how do we actually start to do this? Because in banking, where it's done, you would have an IBAN, you'd have a SWIFT code, so it's very easy to identify your counterparty and to have a correspondent relationship with them and say, okay, I know the bank, I know the branch, I know the account number, everything is embedded. In, let's say, Bitcoin, you just have this long alphanumeric string. How can you possibly know who your counterparty is when you're sending this information? So there were a lot of discussions in May of 2018, and following that we then went to, moved on to sort of further sessions, sorry, a year out, I should say 2019. The FATF then passed the recommendations in 2019, in June 2019. So with those recommendations, it was then embedded that the industry needed to move forwards and to address their obligations in line with regulations that would be coming. And at the same time, national legislators needed to start to legislate for the new recommendations as they apply to crypto assets. So that started almost straight away. We saw Singapore emerge as one of the front runners with their legislation that went straight into consultation. The US obviously had their approach that was from 2012, 2013, and FinCEN reissued guidance on this is what applies, guys. You need to do your KYC and you need to think about travel. At the same time, we had a lot of technology providers suddenly start to emerge saying, hey, we've addressed how to figure out how to send originator information to a beneficiary VASP so that you have all the information that's necessary. And the purpose of this was really to address understanding where a payment was coming from, so that you could screen it for sanctions, you could start to build up a profile, all of those kind of things that allow you to really understand who the counterparty is and understand the full side of a transaction. There have been some sort of challenges around how we can do this, and we're still addressing some of those. But one of the early things we said was we need a standard messaging format. So similar as we would have in Swift, we need something very, very similar that could allow us to all understand the same language. So if I send a date of birth from a US to a UK exchange, is it day, month, or month, day? So what is 12/6? Is it 12th of July or 12th of June or the 6th of December? So it was even simple things like that, but it got even more complicated when you start to introduce names and local language differences and so on and so on. But we formed a group called the Joint Working Group for Inter-VASP Messaging Standards. And this was the three leading industry associations, so Global Digital Finance, a group called IDAXA, and the Chamber of Digital Commerce in the US. The three of us came together to address this, and we had a convener, Sean Jones, who was a former Gibraltar regulator, who really led the group that brought us through 18 weeks of intense work at various hours of the day and night, because the time shift, we rotated the call each week. But at the end of 18 weeks, 130 industry technical experts came together and had produced a standard. And that standard was ratified this May. It has now been signed off. It's called IVMS 101. And that's now being used by a lot of the technology providers to say this will be the baseline standard that we're going to use to transmit information. So now we can all talk the same language. We can start to think about how we're going to transmit that information. Now there was a sort of view that by June 2020, everybody should be in compliance. All of the exchanges, all of the countries should be in compliance. We actually held an event last year at the G20, on the sidelines of the G20, called the V20. And the FATF kindly gave up a considerable amount of time to come and present. And a lot of Q&A. And we did the Q&A sessions, and one of the things that came out was that really the expectation at 12 months is to demonstrate meaningful progress. Can you make meaningful progress towards compliance? And the same also applied to countries and legislators to make meaningful progress towards having regulation. Now, at the moment, we're in this transition zone. So we've just finished the planning. We've now got IVMS 101, so you've got a standard. Now we need to move to proof of concepts and pilots, and then onwards into full production. Parallel to this, we need countries to also then introduce legislation that we hope will be harmonized to avoid regulatory arbitrage. The more harmonization to the FATF rules, then the easier it then becomes to enforce a common standard that otherwise would allow for gaps and finding the lightest jurisdiction in which to sort of use your on and off ramp. As you know, Kayla was talking about that in gaming and being able to get stuff in and out. The same thing still applies to crypto, that okay, you can move it around the system, but at some point you want to get it back out into fiat currency so you can spend it normally as you might want to. So all of this has now come together. We're on that track really towards making meaningful progress. And this week, the FATF will be signing off their 12-month review. And this is what was due for June 2020, is the 12-month review paper. That's already been through the virtual asset contract group. Now it's with that was set up by the FATF. Now it's gone to the plenary for review and sign off, and then it will be published sometime in the next few weeks. And that will give us an indication of how the FATF has viewed progress in the industry. And IVMS 101 was actually a great example of how you can bring together a hugely competitive, hugely diverse industry, particularly loads and loads of different financial services, and make it all fit into a direction where everybody is pointing the same direction. So what we now want to do over the next 12 months is keep that momentum going. One of the key things I think, and maybe Vincent would sort of concur with this from his former role, is that there was an argument of, well, why can't you just go, if there's a payment, why can't you just go back to the originating exchange and ask them? And it was, well, actually, you want all that information to be self-contained. So if law enforcement make an inquiry, they can get all the information from that one source, from the beneficiary exchange. And rather than have to go back to the originator exchange, because perhaps it's actually the originator exchange that's being investigated. We don't know. So having all of that information in one place will certainly ensure that you can maximize the effort, or maximize the benefit, sorry, to then be able to investigate any potential criminality that you then need to look for.
Thank you, Malcolm. Honing in then on the discussion about regulators and the part that they're playing in this, Chris, if we can turn to you, based on your experience, how are regulators responding to developments in crypto assets, and how can we, Malcolm has made some points about what we need from regulation, for example, consistency. What are other things that regulators and regulation needs to achieve to be effective when it comes to crypto assets?
So I think that regulators have really, in the last few years, upskilled themselves massively in terms of being able to monitor this particular market and the participants in it. This is through the human resourcing, through the use of newer tools, and Malcolm covered this. And it has been really good to see over the last, even only say 2 years even, the evolution of these tools. So I think there are probably 4 or 5 major providers, and these providers I'm referring to, they do on-chain transaction monitoring and surveillance, and they have really improved their capture of different addresses and different clusters, so that you can be more confident as an actor in these markets who your counterparty is and whether or not they are associated with illicit activity. As that comfort level and as the accuracy of these monitoring tools increases, so does the increase in comfort level of the regulators and financial institutions. So I think, just to sum up that point, it's really about the education that regulators have done and they continue to do that is absolutely crucial. The other thing as well is that I think you're seeing regulators be more open with the industry and talking to them around the challenges which both regulators and industry face. So if we were talking, say, 5 years ago, regulators were quite tentative. They obviously the crypto asset markets, the reputation back then wasn't so great, and the regulators were to a certain extent still kind of feeling their way, right? You had some regulators, like the Japanese, the FSA, for example, and their regulations that was prompted by Mt. Gox. But really, they were a bit of an outlier. The other regulators took some time to catch up, at least in the larger jurisdictions. Now, as the regulators evolve, collaboration with the industry is absolutely key, whether it's through consultation, whether it's through working group. And this is so that the regulations are fit for purpose, and that they, first of all, capture all the risks that are present in the market to the extent possible, but also so that the requirements don't make business completely impossible, right? It's really important to underline, I think my final point is that it's not often that you see a new asset class being added to the roster of asset classes in financial markets. And this one, not only is a new asset class, it also operates on a fundamentally different infrastructure to the infrastructures that financial institutions are used to using. So it's very, very new for everyone, not just the regulators, but for the institutions as well. And Malcolm was talking about the incredible diversity in some of these collaborative groups, which is really interesting. The discussions are often lively because of the diversity of views and because of the diversity of backgrounds. So you have this incredibly vibrant crypto industry full of very intelligent people that come from a technology background on the one hand. And then you have the more traditional financial services industry, and these people are typically financial services by background and learn the technology. So you've got technologists learning about compliance, and you've got compliance people learning about technology. And so that collaboration is so important to make sure that we develop a market that is robustly supervised, but that also works, you know, in the interests of its clients as well.
Thank you, Chris. I'm conscious that we have probably about 20 minutes left, and we do have a few questions coming in. So let me draw on some of the questions from our audience, and if I can rephrase the first one slightly. There's a question about the rise of using crypto assets, and particularly the reference is made to Bitcoin ATMs to transfer value across borders and circumvent more established methods, as well as I think the question about regulatory arbitrage, which I think we did cover a little bit before. So I would invite questions from our audience on that, and perhaps we can start with some comments by you, Kayla, in relation to crypto assets and evading sanctions, and then broaden that out to the panel to add your observations.
Yeah, sure. So I don't have, oops, sorry, I think that was a notification. I don't have specific comments on Bitcoin ATMs, but I can speak a little to, well, I guess my first comment on that is that the crypto system is not so locked down at this point that you even need to use Bitcoin ATMs in the first place. I think there was another question, I was looking through the Q&A questions about the flight of exchanges to other areas with less regulation. So that to me is sort of indicative of the fact that all the regulation that we've been talking about previously for the last few minutes is key in this, because so as Catherine sort of pointed out at the beginning and on this, one of my biggest projects here at RUSI, as Malcolm is very aware because he helps out with it, is looking at North Korea's use of cryptocurrency. So there you're really looking at a country with significant technological capabilities and funds to be able to do this, to pour all of their effort into it, hacking cryptocurrency exchanges, hacking banks, hacking Bitcoin ATMs, stealing from crypto exchanges, mining illegally on other people's computers, cryptojacking, all sorts. There's sort of, if there's a way that you can be involved in money laundering or stealing through cryptocurrency, North Korea is doing it. So that's sort of a big project that I work on. And I found that it's not that the typologies of that are really any different to any other hacking of a crypto exchange or anything like that. It's just that it's at such a huge scale because you have a state actor doing it. And what that in turn has led to is us trying to understand how you can move that money at scale. So obviously you have, over-the-counter exchanges, but if you're moving hundreds of thousands or sometimes even millions of dollars through cryptocurrency, maybe that's not the best way to do it. And what all of the reports that have come out that we've seen and through talking with experts and people that work at these blockchain tracing companies and all of that is mainly that they move through exchanges with low or no KYC. So either they're in areas where there's no regulation and therefore they're doing what they want, or they're not compliant with regulation because there isn't necessarily a mechanism by law enforcement to force them to comply. And so that's certainly not specific. I mean, it's specific to North Korea, and that North Korea takes advantage of it. But I think it's connected to all of this in that is how anyone moves crypto through the system. And Bitcoin ATMs are certainly a concern. I haven't done specific research into them, but I think my primary concern in general is just this lack of consistent regulation. Because even if there is regulation in 2 neighboring countries, let's say, it won't necessarily be the same. And so some will only regulate crypto to fiat, so crypto to like US dollars, for example, or crypto to pounds, but they won't regulate crypto to crypto. And then you have a gap there where a country that will service clients that are in a non-regulated or badly regulated or less regulated country will not regulate certain bits and pieces. And it leaves these gaps that people are able to exploit because crypto is borderless. If I don't like, I'm in the UK, I'm in London, so if I don't like how it's being regulated in the UK, I can say, okay, well, I'm just going to use a service in a different country. And that country doesn't have regulation, which is why I think the standards that Malcolm was talking about that are coming from the industry itself are so important, and also why the Financial Action Task Force standards and recommendations are so important. And I think that applies to sort of Bitcoin ATMs are indicative of the sort of problems that you would run into when you have gaps in regulation, when sometimes they're okay, sometimes they're not, sometimes there's regulation on them, etc. But more than that, I think the entire industry is just so inconsistent right now that it's not even necessarily, at least my first concern necessarily.
Do any of our other panelists want to add their thoughts on that? And particularly perhaps thinking about it from the perspective of if we look at exchanges as a point at which controls can be applied, does that seem to be an effective approach? And secondly, what else needs to be done? So industry standards are a fantastic first starting point, but Kayla's highlighted some of the gaps that still exist. So what would be the next step looking at industry-wide that we would want to see to address some of those vulnerabilities?
Sure, we'll chip in there. I think one thing is better security. So I'm sure Kayla will agree with this, that there have been a lot of hacks, and that comes with the way in which wallets might be controlled on an exchange. That can be down to a lack of segregation of duties, all of those kinds of things that you'd expect to see in a traditional exchange platform that maybe are missing from a pure tech build that's just sort of come out the door quite quickly. These vulnerabilities make it very easy for the criminal who comes in to say, okay, I can get in the back door, I can do what I want once I'm in the system, and that's it. So I think, one of the biggest things that exchanges will have to address is security. The other one is actually KYC. So aside from the standards, which we know are coming, and we certainly from the industry perspective, we've been really pushing for a harmonization, and actually this is one very good example of where it could be harmonized. So aside from that, then there's also you've got exchanges out there that have been trading for a long time that maybe haven't been doing KYC until now, and now they're going to have to comply with the travel. And that means they're going to have to get the KYC in order to transmit that information. So will they look for the best solutions? Will they look for the ones that actually, for example, do live ID on KYC, or will screen parties in the right way and actually pick up all of the, the potential sanctions hits and so on and so being able to make sure that that information is consistent and secure. And travel aside, I mean, back to a security point, if I'm as an exchange sending my customers' details to another exchange, I want to know that that exchange is actually going to look after those customer details properly. So I think that the journey may take a little bit longer as we start to work out those kinds of things to avoid the risk of potential incidents around data being removed where it shouldn't be.
Thanks, Malcolm. Vincent or Chris, did you want to add anything to this discussion?
No.
Otherwise, Chris, did you want to add something?
I think just to really emphasize the point about consistency of regulation. So, those of us that have lived through any sort of reporting or information, the implementation of information sharing, right? Whether it's transactional information reporting going to the regulators or transaction information as among industry participants, that's never easy. The area that I've had to do that is in the context of EMIR and MiFID II, primarily for derivatives and securities respectively. And it's not an easy experience for either regulators or the industry. So if we can maybe learn the lessons of that implementation piece and apply that to here, so that we don't have a US model and an EU model, which we sometimes get now in the context of securities and derivatives transactions. And that's for the benefit of everyone. It's the benefit of regulators, the benefit of the industry, in the fight against financial crime. That's really, really important. And I think the work that Malcolm has led is incredible in being able to get to a standard that everyone likes and understands, not least because in the Intervast group, there's a participation across many different, absolutely key markets for crypto.
Thanks, Chris. And we have a question, which I think, Vincent, will be one for you, which is, the question on here is, does digital CDD verification compare video clips with images in IDs? And if it does that, surely the issue of an ID having an old image remains. So is that part of the process? How is that resolved? And if so, is facial image more of a deterrent than a substantive control? What are your thoughts?
Well, we are not trying to use technology to bluff people. It does work. Actually, what I just said is, okay, for human being, it is not easy for you to compare the old photo with the guy standing in front of you, because, well, the photo was taken some 10 years ago. But for technology, we are able to rely upon the photo of the ID proof, albeit it was taken some 10 years ago, and then build a profile, and then to compare it with the selfie of the customer. Don't forget, well, actually, even if you undergo some beauty surgery, some unique features of your face cannot change. And that's why the quality of the photo of the ID proof does matter. And in some jurisdictions like China, like Macau, we are able to gain access to the database where the official photo can be obtained. So the quality is no problem. And then we are able to use the original photo of the ID card issued by the authorities to do the comparison. In some other places like Hong Kong, we have to ensure that the photo taken by the customer on the ID proof is of a reasonable quality. We won't make any concession if the quality of the photo is up to no good. And that's why if, for example, it is too dark and the message and the image is blurred, then the CDD process will be redirected to the human manual process, where we will contact the customer to have another photo taken. So basically, the technology is very reliable. We have got the ISO standard, and it has passed the regulatory test.
Thank you, Vincent. We have another question. I'm going to combine a couple of questions together here, as well as add a little bit to them. So the questions are there any new technological developments, and we'll make that about either fintech, techfin, or cryptocurrencies that are especially susceptible to criminal exploitation, or I would say that provide, particularly that strengthen our ability to fight financial crime. So any particular areas in either of those sectors that are strong points or weak points?
To me, as a former law enforcer, I would say anything that is not regulated is more vulnerable. And that's why even for cryptocurrency, crypto assets, when you look at the technology behind these assets and currencies, blockchain is the most reliable technology to have the proper audit trail. You can change the transaction details in between. What's the problem before FATF issues the guideline is, it is not regulated. A lot of people are trying to exploit the tool and the system, and that's why we need to, like what Malcolm and Chris are suggesting, we need to have regulations, and more importantly, we need to have standardized, uniform regulations applying to all jurisdictions. And then, it's easier for law enforcers to keep track of the assets move. It is easier for people to identify who are using the currencies and assets.
Thanks, Vincent. Chris or Malcolm or Kayla, did you want to add anything to that?
I think just to touch on the analytics tools a little bit. So we've seen a couple of early doors sort of tools that have been used for a few years, and they're used by law enforcement particularly. There are now sort of 5 or 6 different vendors who are now looking at different ways to provide that information. So the way the analytics tools work is that they can look at the history of a coin. So if you spent your Bitcoin, where is it originated from? Where did it come before? Did it come from a hacked exchange on the other side of the world? And has it somehow now made its way to you? Has it been through various known money laundering typologies along the way? And you can say that starts to infer risk upon any coins that you've then got hold of. So those tools are actually proving invaluable really to understanding a lot more about the history of transactions. I think with that, it also worth the context here that if you look at a report by one of those tool providers, Chain Analysis, they produced a report just a couple of months ago actually, where they looked at the level of financial crime against the whole ecosystem, or Bitcoin that had appeared to emerge from illicit sources. And when they started to evaluate it, they said, well, it's about 1.2%. So 1.2% of all Bitcoin is actually involved in, or appears to come from illicit sources, whether that's hacking or stolen or something else. And actually the majority of them are from Ponzi schemes or phishing or those types of attacks or ransomware, rather than coming from other laundered typologies. So I thought that was a really interesting report, and there's one a year earlier from Elliptic, one of the other providers, and you start to see the ability to produce these figures and these numbers that out the back that are looking at those particular types of sources, and then you start to address, well, how vulnerable is crypto? Particularly if you look at all the transactions, is it actually really a good idea to use crypto over cash for, if you're really, keen on money laundering, because we can trace you and it is possible.
And Malcolm, on that point, you've touched a little bit on some of the methods that can be used to identify fraud. Is there anything more that you can add on fraud detection when it comes to crypto, and in particular anything that's different from the techniques available for traditional financial activity?
So some of it actually goes back to exactly the stuff that Vincent was talking about earlier. We kind of touched on things like using the metadata, so the additional information you can get from a transaction. So that might be the device ID, the location, the frequency, what time of day, all of those kinds of things. You build up this huge big data pool And exactly the same as you might see in gaming, you can create a lot of additional data because the majority of it will take place on an app or a mobile device. So there's a lot of ability to gain this additional information that helps you to use that in the fight against fraud. The majority of crypto exchanges that are operating to the highest standards of KYC will use non-face-to-face with live ID or digital identity or something like that, address verification, all of those kinds of really good techniques. So a lot of it you'll see elsewhere, more in fintech than necessarily in banks, because you want to be able to draw together the facts. I know that this person is this person, where they live, what they kind of on my platform to do, and then the behavior. Are they actually doing that or not? And then if they're not, then you either your facts are wrong, or you need to go back and have a look at the transactions in much more detail.
Thanks, Malcolm. We have one final question from our audience, which I might present this one to you, Vincent, and see if you have any views. I'm combining two questions together. So the first one is, are there or should there be discussions between regulators or even between financial institutions about creating a central repository for storing KYC data, which could then be accessible to multiple financial institutions as a way of achieving greater efficiency? And also on the other side of that, should governments be using technology to create safe hubs for citizen-based ID depositories? So we've already referred to some government sources of various identification details. So should there be repositories available for multiple financial institutions to use, and what is the role for government in that?
Well, that could be an excellent idea. However, having spent quite some years in the data privacy office, that may give rise to a big concern about data security and data privacy. If, for example, people around the world are having their personal data kept in the cloud, and that could be a big concern. What I would instead suggest is, okay, if, for example, the ID and V, the KYC is done by a tech firm or by a bank in a jurisdiction, with that customer's consent, then, well, if he wants to open another account in another jurisdiction, then, well, once the consent is given and confirmed, the other side could just get the data from the originating or the first institution where the KYC has been done, and there is no need for the customer to provide his personal data, photo, ID proof, occupation, etc., again to the second institution. We are talking about globalization, and that's why, with the customer consent, that could be done. And then we have also addressed the concern about data concentration, the data security, because, well, only where the customer consent is given, then the institution will then pass on the data to the other institution where the customer wants to open another account, wants to have the relationship with. So that would be my thoughts.
And Malcolm, did you have anything that you wanted to add to that?
Yeah, so I was fortunate enough back in 2013 now to sit on the leadership team that built the world's first KYC utility. And the idea was, hey, we're going to build a record once and then share it multiple times, exactly as was sort of suggested in the question. One of the challenges that comes out of that is that just as we don't have harmonized regulation, we don't have harmonized AML policies, even within organizations, particularly large organizations. So what would constitute the baseline? And that's obviously one of the biggest challenges. We've seen various forms of utility be tried now in various jurisdictions, some with success, some without. I think the challenges around it, though, are quite significant, and data privacy is obviously a key one, ensuring that security is a key one. I actually got the idea that was mentioned in China Macau, actually being able to go back to a government-issued ID and verify against that. Now, if you can also make an immutable audit trail using the blockchain to prove that that whole piece came from that government agency and it hasn't been tampered along the way, I think that would be a great win to reducing fraud, to reducing financial crime, and to changing the way that that's done. Because if you have the central source that's actually providing that identity, also verifying that yes, it appears to be true, then it makes a lot of sense to be able to do that in a sort of secure way.
That sounds like a great idea, Malcolm. And when we're thinking about next steps, maybe there's a good next step. Kayla, did you have anything that you wanted to add to the discussions we've been having?
Yeah, I think this is sort of relevant to everything we've been saying, but it just occurred to me sort of as a case study. So obviously I do this North Korea work, and recently a US indictment came out of a bunch of North Korean cyber criminals who were laundering cryptocurrency through various exchanges, and there was a lot of detail about how they were moving it and how they were getting past AML controls and KYC and all of that. And I think it speaks to sort of what good KYC using this sort of digital identity can look like, and what it looks like when you're really not doing that. Because there were, I think, at least 2 exchanges that verified identity but accepted fake, clearly fake documentation, which there were photos of it, and you could see, you know, if I were looking at it, that it was not real. And then there was another exchange that they weren't, you know, listing names, but there was another exchange where the indictment said they tried to go through this exchange, they were using decent KYC procedures and didn't accept it, and they couldn't go through that. So we're listing X, Y, and Z exchanges, you know, and they've moved the money through here. They've moved huge amounts, all of this. But one exchange actually said, no, that's not, that's not valid identification. You can't go through us. So I think that's just like a very, very clear example of you don't want to be named in an indictment. You know, you don't even want people to speculate that you're someone that's being listed, whether or not there's regulation in your jurisdiction. That's just not something anyone wants, at least on a reputational level. And that's the sort of KYC that can keep you out of it. It does exist. It's clear that people just aren't necessarily using it because they were submitting the same documentation to both exchanges, and it was the same people, and it was fake in the exact same way. And one said yes and one said no.
Thank you, Kayla. I'm conscious that we just have a few minutes left, so I have one final question for our panelists. I'm going to ask all of our panelists. Maybe I'll start with you, Chris. So the final question that we are going to ask is, we've spoken about all of these new technologies that are emerging, the positives, the negatives, the challenges and the opportunities. What does this mean for the skill set of the future, particularly for teams that are involved in managing financial crime risks? So if we could pick maybe 2 characteristics that you think are particularly key. Chris, I'm putting you on the spot and coming to you first. Do you have 2 things that you could suggest?
Oh, I've got at least 20. Never mind 2. And not least because I've just finished drafting a job description for someone I need to hire. But so number 1, okay, and this is fundamental. Be willing to learn. Right, that is absolutely fundamental, because trying to find a person that is a crypto asset expert who is also a financial crime mitigation expert, that is really good at talking to regulators, that is great at drafting, can transaction monitor using all these latest tools and do all that. Trying to find one person who does all of that is impossible. I mean, I wish it were true, okay, but unfortunately, I wish it were possible, but it's not, unfortunately. If a person has 1 or 2 of those things, then, you know, we can teach them the rest. Okay, you just have to be really, really willing to learn. And you know, we see a really interesting diversity of backgrounds. As I said earlier, you've got technologists learning compliance and compliance learning technology, right? I'm probably the latter category. I'm a lawyer that got to grips with crypto assets and technology behind it. Equally, some of my colleagues are the opposite. So, number 1, willingness to learn, totally crucial. Second of all, I would say super important is a very healthy attitude to regulation. Okay, so you know, in the crypto asset market especially, various quite prominent people have been vocally anti-regulators, anti-central bank, anti-regulation, right? And you know, I think that to some of the points made by Vincent and Malcolm earlier, regulation can actually be a helpful thing. Right? So FATF recommendation 16, the travel rule, will actually, I think, get in both regulators and institutions more comfortable with this market. So we're willing to learn, health attitude to regulation. Top 2.
Perfect. Vincent, two things. We're in the quick fire round now, so two things that you think are really important.
Actually, that's the motto of my firm: embrace change.
Mm-hmm.
Wow, the world is changing every day, and for AML professionals, we have to learn fast about the changes in technology. We have to convince the regulators to learn how technologies can enable AML to be carried out in a more effective manner. And we have to educate the tech firm folks and business people to embrace change in terms of more intensive regulations on new technologies and products. The second thing I would like to share is to understand why. Don't just look at the face of the matter. You can't just say to the business people, hey, this is the regulation. You have to let them know why we have these regulations. What are the risks that the regulators are trying to address? If we can come up with something which is equally or even more effective to address the same risk, we can then go back to the regulators to say to them, we won't follow your regulations, but we will have something more innovative to achieve the same impact.
Yeah, and I think
so
that touches
change and understand why.
And I think that touches on the point of effectiveness as well, and making sure that regulation is achieving the result that it intends to achieve. Malcolm, quick fire, two things that are important in our skill sets for the future.
Oh, be holistic. So actually, Chris kind of touched on it. Don't sort of have a one skill and that's your only skill. So the ability to move from transaction monitoring to KYC, because as you start to pin together facts and behavior into one thing, you need to be able to understand how both of them look. Understand what new technologies, as back to the learning piece. And actually, I did a webinar a couple of weeks ago where we did a poll. And the poll was, are you planning on upskilling? And 90% of people said yes. So I thought that was really encouraging. But it's understanding, being able to understand new typologies. It's the same old crimes, it's just a different way of actually presenting them. And the last one is to be commercial. So for a long time, compliance was the business prevention unit. I think very much now we're moving into that commercial business strategy focus. So a different side of technology is something like social media and Twitter. And it can destroy a company in minutes. It can destroy the reputation of the whole company. It can destroy whatever. Actually, this is where compliance can play a key role, because being able to say, well, we're doing these things in the right way and we've got the policies and procedures and everything to back them up, mean that you're less likely to see bad things coming out through social media and through existing news channels with the speed at which they can do that. So having that sort of commercial lens, I think, is really important.
Thank you, Malcolm. And Kayla, the final word for you on what you think the skill sets are of the future.
I'm not sure these are necessarily my top two, given that we've had some. Yeah, so my first one would really be to understand the landscape, because I think you have people saying, okay, well, I'm just going to worry about banks, or I'm just going to worry about crypto exchanges or gaming. And I think for me, the benefit of me being in this sort of think tank research position is that what we do is, for our research, we talk to anyone that we think could be relevant. And what we found is that their views on each other and on the same issues are very much not in line a lot of the time. That can be good because it can lead to good ideas, but it can also be detrimental because you do see that they're not necessarily talking to each other. So that really can encompass anything from private sector entities speaking to each other, private-public partnerships, associations like the ones Malcolm was talking about in the crypto space. And they're certainly growing, but it's something that I see not only in sort of emerging payment systems, but just throughout, is that people don't understand the full landscape of what the relevant stakeholders are and what their ideas can lead to. And I think that would just be my second one, is understand that innovation might come from places that you don't expect it to, and be open to it. I don't want to put this on traditional banking institutions, but they are less likely to embrace new forms of innovation than, say, fintechs are. Crypto is in a space where they've been created, so where all of it, the whole landscape has been created so recently that it's constantly changing. I mean, even when I started looking at it, the conversation about regulation is completely different where it is now. So innovation in the digital identity that we were talking about, innovation between, fintechs bringing ideas to traditional financial institutions. So yeah, I think sort of the two together, understanding who the stakeholders are and why they're valuable, and that they can come from places that you don't expect, and looking to them and looking to people with new ideas for innovation.
That is a fantastic final note, Kayla, to emphasize the point of working together as a community and sharing our different strengths and finding solutions together. So I want to thank everyone who's joined today. Thank you first of all to my panelists, Vincent, Chris, Malcolm and Kayla. It's been a very lively discussion, and I really appreciate you sharing your knowledge with all of us. Thank you to those who joined the webinar. It will be recorded, so if you had any connections who weren't able to join, then please do share that recording with them. And thank you in particular to the team behind the scenes at both RUSI and Standard Chartered for all their work in making this happen. I know there was a lot involved, and we really do appreciate how well it's gone today. So that is the end of today's webinar. We have another one coming up, the third and final one in the series, in a couple of weeks, which will be on cybersecurity. So thank you, everyone.